Good day, and thank you for joining Tyler Duncan Really Partners monthly podcast on this Thursday, June 27th, 2024. My name is Chad Tyler. I'm here with my colleague, Charles Shapiro. In a minute, Charles will say hi and kick us off with our discussion today. So today we're going to talk about what we think are some interesting investment opportunities in the office market sector. And in particular, there are early entrants into this sector that we would consider contrarian investors. So there's some interesting things happening there. We're going to talk about why they're happening, what kind of opportunities we see there. So with that, Charles, you want to say hi to our listeners and get us kicked off on our topic today?
Absolutely. Thanks, Chad. Well, hello, everybody, and thank you for listening in to us. The one thing that we all look for when we're talking about investments is, what's the new thing? What's the investment that we can be looking at that we can make a lot of money on? Well, Chad and I think that it could be in the office sector, and a lot of other people agree with us. And we have this great quote by Nathan Rothschild: "The time to buy is when there's blood in the streets." And what we really mean by blood in the streets is you have prices of assets that are low, on assets that are hated, nobody wants them, and we can see, that they're on an upswing or close to it, and Chad will talk about that later. But what we've been talking about over the last few months is the whole effect of COVID and how it's killed office. How the vacancy rates are still going up. In the last year, it's gone up 2 percentage points. That's almost 20%, or over 10% in terms of vacancies. Prices are down 35% from their peak, and the Wall Street Journal is talking about a bunch of properties that are in default. Add that to higher interest rates, which means the cost of operating real estate is going up, and you have yourself a problem asset class. So, we were talking about, well, when are we going to recover from the COVID market? Well, if you look at the graph over here, this white line at the bottom is showing occupancy rates. We're at 50% occupancy. People are not coming back to the office yet. And in other parts of the world, they're seeing similar problems, but not as bad as us. But it is an international problem. So what we're seeing is that there's a lot of industry experts out there that are saying, now is the time. It's a generational opportunity to find great assets and pay pennies on the dollar, maybe. So, Chad, I'm going to hand it over to you because I want to find out, why do you think now is the time? Why is the timing now for looking at office as an investment opportunity?
Sure, I'll speak to that, Charles. And just to be clear, the chart that Charles just showed in terms of occupancy levels, that really reflects essentially bodies in the office. So right now, as Charles mentioned, in terms of vacancy rates for the U.S., we're at about an average of 18% for office. But in terms of the number of folks that on a percentage basis after COVID that have returned to the office, we're about 59% in terms of employees back in the office. But Charles, to your question, why now? Why is it time to focus on office acquisitions? And the fact of the matter is, right now, we're seeing the spigot really open up considerably with distressed office properties coming to market. And just by way of example, so in 2023, the overall sales volume in terms of office buildings sold, that was off by about 60% over 2022. So it was down by 60%. Year to date through 2024, we've been seeing similar slow levels of sales volume. However, that's starting to pick up. And the reason why it's picking up is because loans are going into default and lenders cannot continue to push off foreclosing on these properties and bringing them to the market, or perhaps selling pools of distressed debt, which we're seeing more of. So just by way of example, and this is one of several examples, but just by way of example, in April of this year, 2024, 1101 Vermont Avenue in Washington, D.C., sold for $16 million. So just to put that in perspective, that's a 175,000 square foot office building. It's a Class B building built in the 1980s, but that's about $90 a foot. That building last sold in 2006 for $60 million. In addition to that, it was valued or assessed for tax purposes in 2018 of right around $72 million. So again, that sold for $16 million, and that's indicative of some of the discounts that we're seeing in the marketplace. Other reasons in terms of why the inventory of distressed properties is going to increase rapidly and significantly, sticking with the debt discussion. So right now it's forecasted that by the end of 2024, there's about $150 billion in debt that's rolling over tied to office properties that has to be refinanced. So that's going to be a challenge because occupancy levels have fallen, operating costs have been rising, and values as a result have just come down considerably. So it's going to be a challenge refinancing that debt. And that's out of a total of about $920 billion of total debt tied to the office market. So, we're seeing in particular some continued weakness with the Class B and C properties. There's more, leasing momentum as it relates to Class A properties. So Class B and C properties in particular are very challenged. Nevertheless, we are seeing, right now some sales that have taken place in the last couple of years. They've been at compelling discounts, and that's creating a lot of attention from investors, and we're seeing a lot more investors raising money out there for making acquisitions in the office sector. But it's important to realize those that are making acquisitions now, and those that are likely to jump into it here near term or as the pool of distressed properties increases, they have a very sniper or laser-like approach. As we said, the fundamentals of the office market overall, particularly in the U.S., are still years away from getting to a meaningful recovery. Having said that, there are certain markets, major metropolitan areas, that are actually doing considerably better than others. So, for example, Tucson's one, Miami's another, Tampa, and there are several other markets that are actually doing considerably better than the national market. So these investors that are getting aggressive on office acquisitions, they're being very discerning. They're looking at things like the age of the property. There's a disposition to try and get more Class A properties given the better leasing momentum there. In the case of older properties, there's better opportunities for conversion given smaller footplates to residential. They're looking at submarkets in great detail. Medical office in particular is still doing very well. So again, they're taking a scalpel approach to their acquisitions. Charles, with that overview, just from a big picture, 1,000-foot level, what are you seeing in terms of overall strategies with investors that are getting aggressive in the acquisitions with the office market?
Well, we're seeing two primary strategies. The first one is to simply take existing properties and reposition them. I mean, the first thing that has to happen is that there's going to have to be a change in the balance sheets. There's going to be a lot less debt. And by the way, everyone, I know that these slides don't look good. I thought I moved them, and I apologize. My bad. But what they're going to be doing is making sure there's more cash in the capital structure. They have to do that because they're going to be putting a lot of money into upgrades into the building, which means they've got to buy the property at a low enough price that they can afford to do all of this. So there's going to be significant cash that's going to be required to put in more amenities because if people are coming into the office, they want it to be a great environment. So you're seeing exercise rooms, and you're seeing better food courts and things like that going into these office buildings, because what investors are looking for right now is what are the buildings where people want to be. So what are them? They're in cooler, newer buildings, vintage neighborhoods, a mixed use environment, maybe near apartments where somebody lives close by so they can walk to the office. And that's where we're seeing tenant demand is really high, and where they're still getting good prices, when they're talking about selling those properties. The second approach is to reposition the property. So if you've been reading a lot of the newspapers, you've probably heard in certain areas, they're talking about turning office buildings into apartments, into residential buildings. And so these are great ideas. The challenge is that it's really hard to do because some of these office buildings are simply not set up to be apartments. Because what do you want in apartments? You want lots of window line. You need to have all the bedrooms with window line. You need to have the living rooms with windows. And a lot of the floor plates don't set themselves up too well for that type of use. So the other thing is that the HVAC systems and the buildings, the HVAC systems are set up for all the individual apartments. The office buildings aren't set up that way. So they're going to have to be completely overhauled, and it's going to be a huge cost to do that. But regardless, you see a lot of government support for it with tax credits, financial support. They want apartments because what does apartments bring? It brings more bodies into the downtown areas, which is what they want. They want office and apartments. They don't want to have office anymore where at the evening it clears out and nobody is there. So, in looking at the markets that we're seeing a lot of conversion to apartments, the number one market in the country is Washington, D.C., which I find fascinating because obviously the bigger tenants over there are law firms and the government, but Washington, D.C. is leading the way. But you see a mix of big markets and small markets. That's what I find fascinating about this, Chad, is the mix of markets. It's just not, all the major markets around the country. So, the design firm, Ken, so we were talking earlier about why some of these office buildings don't lend themselves well. They looked at 300 office buildings around the world, and they found that only 30% are real candidates for conversions to residential. So for those buildings that are real problems, owners are looking in different ways. They're looking at turning them into self-storage facilities, hotels, data centers, anything that they can do that is unique, that can turn that property back into a profitable property. So everything has their unique challenges, and it's going to be really, really it's going to be a challenging market moving forward, but we're going to see conversions. We're already seeing them, like I said, in DC. Out here in Denver, there's a lot of talk about certain buildings turning their way around, but again, the floor plates have to work. So, Chad, if you're talking to investors, and what we're talking about today, what do you want to leave with them as the main ideas that will help them as they're looking at properties in the future and looking at office properties as investments?
So, Charles, I think some of the big takeaways as we look at the market are, number one, we're in the very early stages of the opportunities. We think about it in baseball terminology. We're probably in the second inning of a 9-inning game in terms of these opportunities unfolding and considerably more distressed inventory coming to the market. Just by way of example, like right now, the Wall Street Journal projects there's about $38 billion of office loans that are in default. And that's the highest level since 2012, and it's also expected to continue increasing. But the contrarians, they're looking at it from a different perspective. I mean, they're looking at it from a long-term perspective, and the market will inevitably recover for the office sector. I mean, right now, factors that are helping it recover are there's very low new construction, very low new inventory coming to market as it relates to office properties. As you mentioned earlier, there's also a lot of emphasis and focus from governments at all level in providing support and trying to encourage employers to get employees back into the offices, but also to carry out the conversions that you spoke about, particularly to multifamily and other types of asset types. So in addition to that, as we mentioned earlier, it really takes a laser-like approach in terms of looking at opportunities, looking at a lot of opportunities, drilling down into those markets that are bucking the trends and doing well. But the fact of the matter is there are quality assets that can be acquired at the right prices that are going to generate long-term good returns, net of carrying costs, net of the higher tenant improvements that need to go in, net of some of the capital investment that you mentioned to spruce up properties and reposition them. In addition to that, clearly everybody just needs to be very conservative in their performas. As you mentioned, it's not just the higher initial equity you have to put in with the initial acquisition, but you certainly should plan on more TI dollars, other capital improvement monies being invested, carrying costs, things of that nature. There is a disposition towards those that have been buying early towards Class A properties for the reasons we mentioned earlier. There's better leasing momentum there, and they've been able to get the Class A properties at decent prices, even though the fundamentals there are better. So, with older properties, as you mentioned, as we talked about, while they can be challenging as it relates to specifically conversions, they tend to be easier to convert to like multifamily because of the smaller floor plates. So that's what investors are focused on there. So that's what we're seeing in the marketplace, and we're going to wrap it up with that. Again, as always, we appreciate you joining us for our monthly podcast, and we have our contact information on the last slide. If we can be of assistance to you in terms of sharing with you what opportunities we're seeing in the marketplace, or if you're looking at an investment that you want a second set of eyes on, please reach out to us. So thank you very much. Look forward to having you join us next month. Take care.
Bye, everyone.